Wealthies, welcome back. If you're new here, this is All the Wealth, Wealthmore's wealth building channel. And I'm Mical Jeanlys-White, the founder and CEO. And with me today is Matt, our portfolio strategist. And we are going to talk about what is happening in the markets and what is happening in the news. Matt and I were here in January, giving you guys an overview of how the markets ended last year and some tips for this year. Now, so much has happened since we were here, Matt.
Yeah, if we had any idea what was happening back in January, it was completely blown out of the water. No pun intended there.
Yeah. I mean, we were unpacking 2025 and what happened with the tariffs and, feeling like things would be far more resolved coming into 2026. And now here we are with what is being called
The special operation going on in the Middle East,
the
it's hard to
special
say what
operation, which
exactly it
is
is.
right. And the special operation is happening in the Middle East, but happening to us in the financial markets in a huge way.
I'm old enough to remember the big market crash of April 2025. So every year we seem to get something thrown at us that we're not expecting. This year it just happens to be at the Middle East conflict. From an economic point of view, the biggest thing is that it's being driven by oil prices and interest rates. So that's going to be what we'll talk about a lot today, I'm sure.
For the folks who maybe are not tuning into the financial markets, maybe you're seeing it at the gas pump or you're seeing it in your 401k and what's happening there, or just like, hey, your favorite stocks are probably getting hit. Though for many of you, your favorite stocks are tech stocks and they seem to be faring better than most in the market. But we should go back a little. We had Liberation Day last year. This one came a little sooner. We have a special operation, call it a special operation, call it a war in Iran, but this has dramatically impacted oil prices. And many of us probably were not thinking about the Strait of Hormuz before now,
Yeah,
but
no,
now
for
it's all over
sure.
there.
Yeah, and oil prices are really, when I try to not be too technical, it's gonna drive inflation higher if oil prices are higher. So the big concern is it's an S word called stagflation, and that means high inflation and lower growth. And when you get those two working together, it's not a good thing for stocks, it's not a good thing for bonds, and it tends to really affect portfolios. That being said, the pullback we've seen this year it's quite normal, right? We've seen maybe 8% down from the January peak, not including the pre-market today, which is bouncing quite high as I look at it here. Well, that's pretty normal for any year. Almost every year you see a correction of 10%. In 2023, we saw one of over 10%. In 2024, we saw a drawdown of just under 9%. And then last year, of course, we had almost 20% down in the year, and all three of those years ended up with really strong double-digit gains. So it's quite normal to see temporary pullbacks like this. Hopefully, temporary pullback. And it's just volatility. It's the price of investing, right?
We should double click on that because we talked about this in January that the headlines at the beginning of the year or even throughout the year do not dictate what the full balance of the year will be. So when people are reacting to the headlines and panicking or pulling your money out or saying the market is down, so I'm not going to put any money in, that may not be the right approach, right? Because these fluctuations happen. What's happening in the Middle East is a very oil centric. We talk about concentration risk a lot. And, the Middle East is a massive producer of oil, which we need for just about everything you can imagine. You're seeing it at the gas pump, but it impacts the facilities you're in and out of. It impacts, even to a certain extent, the energy that we need for the AI, all the
Yeah.
work that folks have in store for the AI. The data centers so far haven't said anything, but that is also why the market is concerned because there's a lot of money that we've poured into tech which requires energy to power the data centers.
It's one of those things that economists call it's called a salient price, if we want a nice different word to pull out. And that means that you see it right away. Consumers in the US, consumers are still a massive part of driving the economy. And if you start to see the gas pump go up from under $3 a gallon to 3.50 to almost $4 a gallon, you're seeing that every day, and you're adjusting your habits. Builds expectations of higher inflation. And if a tank of gas costs you an extra 15 or $20 each time, that money's got to come from somewhere, right? So you're going to have to maybe cut spending. Maybe you don't go out for the meal you're going to go out to. Maybe you rethink your weekend trip in the spring. You start to save a little bit of extra money just to pay for that gas extra, and that can really, that and the expectations of higher inflation can really, um, you know, put the economy in a tough spot if it's not a booming economy, which I don't think I would classify what we have right now as a booming economy.
No, it definitely feels like we're sort of treading water where
Yeah.
we're unsure, right? We've been in this inflation game for now, what, 3 years of trying to figure out like how do we get inflation down to 2%? We're not there. We were also coming into the year with slow growth in the economy driven by the tariffs. And we got, the dollar amount of what that meant. The tariffs cost the average American household $1,000. There are other numbers out there that range higher than that. And so you were already seeing this sort of like, we're kind of waiting and trying to figure our way out. And now you have this added component, which hits immediately, right? We already see gas prices up. We see more concerns about inflation. We see companies worried about what this will mean for earnings growth. If the US consumer is not spending, that has the ripple effect to earnings. And hence why you guys are probably hearing a lot of talk about let's get this resolved quickly. We are into day 30 something of this, and people are like, we want this stopped, resolved quickly because that Strait of Hormuz is just that critical to oil going to just about everywhere in the world, including some of our biggest trade partners.
Yeah, and it's that stagflation word that we're concerned about. So, with higher oil prices, you might have slower growth, especially given like we mentioned, the economy wasn't exactly booming before all this happened, and higher inflation. So, prices are rising. Oil has such a huge effect on everything we do, right? From the cooking everything we eat, gas in our cars, flight prices, all these things. It has such a knock-on effect for everything that if you get a huge spike in oil prices, it can have an outsized effect on inflation. So that's not good for stocks, because what that means is interest rates are going to have to stay higher. So we saw that with the, I don't, again, 10-year treasury bond. It's kind of a how they people sort of measure what interest rates are going to be. So higher interest rates are bad for growth stocks because you have a lower multiple that you can get long term. And then also for fixed income for bonds, like we tell clients that you should have a balance. If you have a balanced portfolio, you want your bonds to kind of offset the risk in stocks. But if we have an inflation push like this, that's actually negative for stocks. So at the same time, you're going to have, a bulk of your portfolio moving in the wrong direction. Again, not to be all doom and gloom here, because today we've seen the markets are going to be off to a good start here in about 45 minutes, which will recover some of that. And it hasn't been an abnormal move in the sense of year to year stocks, but it's something obviously for clients to know and be aware of when they take a peek at their statements this month.
Yeah. And we use these opportunities when we're on the podcast to also just educate, right? To
For sure.
demystify it. So we intentionally go at a pace in which we are explaining versus reporting because we want you guys to get confident, get aware, understand just sort of the heartbeat of the market, if you will, the cadence, what you can expect to happen in a given year. if you're looking at the S&P, if you're looking at the heat map, right? For those of you who are wondering what the heat map is, but there's generally this map and it's green and red and it shows sort of some of the biggest companies and what they're likely to be trading at. That confidence, that awareness is what will make you guys even better, savvier investors, will prevent panic selling, will have you also having more informed conversations when you meet with your Wealthmore advisors because, hey, right? And we want you guys to know, we want you guys to understand the impact of energy, the impact of inflation, and hopefully you guys understand sort of like the moves between the bond market and the stock market, even though we've had some abnormalities last year where,
Yeah.
one price, they're supposed to move in sort of opposite direction and they were moving more together. I'll let Matt unpack that a bit for you guys, but generally we expect the bond prices go up, for stock prices to go down, and the other way around.
Yeah, so I mean that's what we were talking about a little bit is when we design a balanced portfolio, balance just means some in stocks and some in bonds. And what you would expect is that if stocks are not doing well, people rush to buy the safer stuff, the bonds. And what that does is drive your bond prices up at the same time your stocks are going down, gives you a little bit of balance, of course. Now, unfortunately, last year and this year has been a little bit different because of the inflation question. So, if inflation is going up, people also want to sell bonds. So, what you have is the market's going down, stock market, and then bonds are going down because of inflation. And then, the whole of the portfolio doesn't have that balance you were expecting. These are abnormal times. That doesn't mean 10 years from now that's going to hold for every single year, every single month. It just means that this time happens to be the case. And we just have to kind of ride it out, for me and for you, I'm sure too, when I see stock markets acting irrationally or big down days, my first instinct is actually the opposite, is actually to go find some money I can anywhere and start buying when I can. Cause, when you set up a portfolio for, 10 or 20 or 30 years from now, you want to take advantage of days where there's pullbacks because they're, stocks are on sale. Let's buy some, right? Why would I want to buy stocks when they keep going up? I want to buy them when they're down and then just wait. So,
You got it. It's also, some folks will be logging into their accounts like every day.
yeah.
Some of you should not do that.
Yeah.
I'm just going to be honest. Some of you probably should not be logging in every day because you might miss that average dollar cost effect, right? I remember early on in my investing days, probably some of the best things that happened came from not logging in, not realizing when the market had dipped and having money in my 401k and it just automatically would get invested. So I would get the benefit of those dips versus maybe if I were looking at it every day, I may have gotten nervous and felt the need to like change the investment strategy. I certainly remember doing that when the markets got really hectic in '08 and regretting it because I didn't go back and change it.
Yeah. The question's not, has my FK gone down? Is this a normal market drawdown or is it a reason to abandon my financial plan? Most of the time it's the first one. It's a normal market drawdown.
And for some of our, listeners, wealthies who are looking to purchase a home, I know that's probably also tough news in the market, particularly around the interest rates, but I don't think it changes your long-term goals around that in
Yeah,
terms of.
and short term, long term, short term, like those are differences you need to really establish within your portfolio because short term money shouldn't be in something like stock markets. If you want to buy a house in 6 months and you need that deposit, you don't want to gamble with it in the stock market for 6 months. So that's something that would be built in throughout your plan as well.
Yeah. I want to double click on this because we see folks using the wrong sort of investment vehicles for different things. So things like your emergency fund, money that you need in the next like 12, 36 months, let's say, that should be in a high yield savings account, something where you're getting a bit of money back, hopefully offsetting inflation, right? So if you can get a high yield savings account that's paying 4% or something, that's what you want to do. Hopefully, that is either matching or offsetting inflation. Normally, these accounts would do better than inflation, but that's sort of where we are today. The longer term money is where you should have that as an investing strategy so that you can benefit off of the historical returns we've seen in the markets, which have been anywhere between 9 to 10%. Right. So I want you
Yeah,
guys to have sort of headset on both of those.
yeah, and again, just to rehash a point, the last 3 years we've seen, almost double-digit drawdowns or almost 20% last year, and those 3 years were both positive 20% years. So, we're having this conversation now in late March. Who knows what the stock market and the economy and all this thing is going to look like a few months from now or even next week? We don't know. So,
Yeah. And we should just go back to having systems in place, right? Because I think where people are missing opportunities is where you don't have a strong system in place. You don't have clarity around what is my plan, like what is my objective? And then you're not putting in the right mechanisms to stay on track, right? Here at Wealthmore, our system for folks is pretty clear. We want you to have a financial advisor so that you have a plan, you have clarity around this is the goal and here are the steps to get there. And then we build a system around it to ensure and help you with that progress. So
a system and a good team behind it as well helps.
that's the point, like having a process that's disciplined, that's intentional, so that you are investing every month. And with that, you are buying across and you're getting that good average dollar costing and you are continuing and making progress. And if you have a day in which you need to change that strategy, you meet with your advisor, or if you just want to revisit it because so much is happening in the market and you want to make sure this still makes sense for me, you have an advisor there. You can talk through these things. You can pick up the phone and meet with one of your advisors, or you can email us. Like Matt and I would love to get your questions and we can look into it and come back on the pod or respond with an email so that you guys have a plan and you're working it and the system is working for you. And when you invest at Wealthmore, it's going into one of the four portfolios that you're matched to. But every time you put more money into your account, we're automatically investing that so that you get the benefit of one, staying on track. We see this all the time. People have the best of intentions, but they don't have a system to actually execute it, to keep it
Look at
going, to stay on track.
Yeah, look, money's emotional. There's no way around it, but you do have to take as much emotion out of it as you can and really make it, you know, make it about making money, not about how you're feeling that day. Because if you go by feelings, the last 2 years, it's going to be real tough to invest in a market like this. And what we've seen too, like some of the worst days in the markets, they're followed by some of the best days in the markets. So, we have to really keep that in mind when you see the headlines and see the fear and all that going on. You need to just take a step back and not look at your portfolio or, you know, make sure you have a plan in place that lets you sleep at night better, if that makes sense.
Yeah. And have diversification at work, right? I will never critique or judge having individual stocks. I think people love being able to say, I bought this, I invested in this, but that individual stock is not a diversified approach. This is why these managed portfolios that we offer make so much sense because Matt is looking at these things. He's looking at the bond market, he's looking at the stock market, he's looking at the mix of what we have in our portfolios so that we are clear on what we expect these different portfolios to do, be it a year of tariffs, be it a year of a special operation war in Iran. We are looking at these things, right? We are seeing oil prices be impacted. But on the same side, the US is a great producer of natural gas. And you guys
Yeah. And
do
oil as
benefit.
well.
and oil,
Yeah,
right? We benefit from having some of the lowest prices for natural gas. That's a benefit. Markets are coming to us looking for natural gas, and they pay for.
different. It's a different world than back in the 1970s when, the US was importing a lot of its oil to make the machine go, with fracking and all this other things that are going on. The US sort of benefits from higher oil prices much, much more than they used to. So,
You
even
got
with all the worrying out there, like there are offsets. It's more diversified economy, if you will.
You got it. We are not sort of, we have our own economic strengths, and that diversification allows us, that mindset of being diversified allows us to look into the sea of opportunities and look at, okay, where does it make sense to make tweaks? Where do we, how do we respond smartly to different events in the market so that these diversified portfolios still do well for our Wealth More members? That
Yeah,
doesn't change.
absolutely.
And that is like, we talked about this in January. That is the peace of mind, right? Like,
Yeah, for sure.
you know, I know Matt is in Morningstar looking at the portfolios and making sure they make sense. It's one less thing I have to worry about because we have the professionals looking at it. And I can have that confidence of knowing it's always a good time for me to stay invested in the market.
Yeah, we sort of said this back in January too. If you're investing for 20 years from now, are you gonna remember the week or two that the markets sold off 8%? Probably not, right? You're going to be looking at the bottom line, and look at where the market was 10 years ago. Like you would say today, you would say, "Oh, I wish I put all my money in the stock market 10 years ago." And that's just what we've seen again and again over, 100 years. So,
I can't tell you guys enough. My wish for our listeners is that you guys walk away from these episodes feeling more informed, more confident. If I literally could take the confidence that Matt and I have and like sprinkle it around, because
yeah,
that would just make you guys that much more informed. But we got here by staying informed, by understanding the markets.
it's because we both have enough battle scars that we know this is not a thing we need to worry about.
You got
Obviously, it's important, and we need to pay attention, but we know that this isn't the worst thing that's ever happened in the history of the world, in the history of the stock market, and it's gonna happen again. So yeah, call it battle scars, if you will. We've been through it. We know it. It's just normal. It's the price you pay for getting higher returns than cash, right? That
yeah.
8% or 7 to 9% average long term. It's not 7 or 9% every year. So, we will have a down year at some point, I'm sure. Whether it's this year or next year or 5 years from now, who knows? So, but that doesn't mean 10 years from now it'll be lower. That I do not expect.
And the unfortunate reality is conflict, wars actually have shown to boost economies because of the production. And we're not sponsoring wars here. We're just stating the facts that historically, times of war have actually boosted economies.
It's government spending, right? So if you've ever taken an economics class, they've taught you how to calculate GDP, and it's C plus I plus G plus NX. So that's consumer spending, investment in business, government spending, and net exports. And that government spending, when you have a war and the government's spending a bunch of money from producing weapons and army expenses and all that stuff. They're spending money, and it's going, there is a trickle on effect for the local economy as well. I also I'm not sponsoring war, and I do not think it's a good idea. And there's so many better ways to make your economy go better. But at the end of the day, historically, what we've seen is that, wars can actually help economies as well, as backwards as that is. Oh,
So, guys, here we are at the end of March, having yet another interesting year. And we will close this out reminding you of having the right systems in place. Um, those who are going to make progress or those who are informed about the markets have a system in place and work that system. It's not going to happen magically. It's going to be based on intention and execution. You guys have to walk away from these episodes and have clarity around your plan. If you don't, you can go to wealthmore.net. We just put up our wealth plan puzzle, made it accessible to everyone. If you don't know where you stand, it's 3 minutes. Fill out the puzzle, get some clarity around where you stand. But the most important thing is to open an account, start working with an advisor. We offer a free intro call so you guys can go on, look at any of our advisors that you may want to work with, schedule a free intro call. Many of the advisors have been here on the podcast. You've gotten to know them or look at previous episodes and then start investing. Invest in the portfolio that you're matched to. Stay investing. That is the key. This will not magically happen. You will not wake up one year and be like, wow, I'm like swimming in wealth when you have not taken these proactive, intentional steps and haven't sort of put in the time and energy to work with an advisor. We have fantastic advisors on the team. You know, it's a pleasure to be here because I'm privy to so much talent around me and Matt and our advisors. And that's what we want for our Wealthmore community. We want you guys to have the same access, the same information, the same confidence, and the same progress around your wealth goal.
Yeah, for sure. And, we're all happy to have you as well.
Thank you, Matt. Thank you. So, wealthies, I told you guys I would try to find another creative way to tell you the same thing. I'm still working on it. So bear with me. For now, it is stay informed, have your advisor by your side, and work the system. We have the system in place to help you guys make that progress. And we will soon be introducing Maura, our AI wealth coach, plugged into these tools, the annual goals, the challenges, your portfolios, just to give you that additional support so that our system becomes even smarter or more tech enabled to help you guys continue with the progress.
Just let everyone remember that, diversification and these it's not about avoiding market losses. It's about getting through them. So that's the other
Absolutely.
way to say the same thing again.
Matt, spot on, because I can't remember the dips last year. I do remember you telling me how well my aggressive growth portfolio did.
Exactly.
I remember.
Yeah.
So
Just
wealthies,
as long as you didn't talk to me in April, you're okay last year.
we know Matt was on top of it. So wealthies, until next time, this is All the Well. We'll be back soon. April's Financial Literacy Month. Stay tuned for some more episodes. I really want to talk about debt. So stay tuned. Go to wealthmore.net. Invest Plus is $25 a month. Premium Advice Plus is $125 a month. Get a wealth advisor, work your system, stay informed, come back to the pod. We will keep these conversations interesting and informative. Until next time, all the well.